Have you ever saw your financial statement and look at the healthy profit and thought, wow, the business is doing great, but only to find out that, well, the money is not there. You don't know where all the money go. The cash is not there. If that sounds familiar, you're not alone. Most small business owners only see their numbers at the end of the year when they need to file taxes for CRA. And by then, the money is already gone, turned over to somewhere else. In this video, I'm going to show you how to finally understand the numbers without an accounting degree. Hi, my name is Chair Chan, a chartered professional accountant located in Oakville, Ontario, Canada. And I help Canadians like you to understand your financials and run the money side of your business so then you can grow with confidence and get to keep more of your hard-earned money in your pocket. Today, I'll walk you through the 3 reports that every business owner should look at, and I'll show you with real examples from 2 different businesses, a doctor's clinic and an Amazon reseller, so you can see exactly why profit doesn't mean that cash in the bank. But before I get started, if you find our video useful, make sure that you give us a thumbs up and hit the subscribe button below. Now with that, let's get started. Let's look at the 3 reports that every business owners need to look at. Let's start with the basics. These are the 3 reports. The first one is called the income statement. Sometimes they're called the profit and loss statements, and this tells you sales, expenses, and profit over a period of time. Now, the second report is called balance sheet. This is your financial snapshot on a specific day and what you own and what you owe. And that's what left over for you. And the last one is the cash flow statement. This one bridges the gap between your profit and loss statement with your bank balance and help to actually understand how the money moves within your business and inside and outside of your business, and why your bank balance does not always match what's shown on your profit and loss statement, and answer the most classical question that I get: where did my money go? Even though I made this much money, I don't see it in the bank. So it sounds simple, right? But when we look at real examples, you'll come to appreciate how these different reports can help you make business decisions as well. So now let's look at the first example. We have Dr. Patel's financial statements, income statements on screen, and who runs a medical clinic. And his 2024 income statement shows that he made $1.2 million of income. After $750,000 of expenses, he's left with $450,000 profit. That looks amazing, almost a 38% margin. And on paper, he's definitely doing amazing. But profit doesn't really tell you the true story. Now, here you see a copy of the balance sheet, which reflect the assets and liabilities that own as at a specific point of time. And Dr. Patel has about $60,000 cash. He is still waiting to receive an additional $200,000 from the government in receivable from patients that he's seen but hasn't collected the money, and he has about $250,000 loan to pay back. So even though the profit and loss statement is showing $450,000 profit, but the reality is that his liquidity is tight because he's waiting to receive that $200,000 from the government on the patients that he's seen, but he also has a $250,000 loan that's outstanding to fit up his clinic, and he can't spend those receivables until they are collected. And this $250,000 loan is a huge weight on his shoulder. This is what I tell clients all the time. The balance sheet is just as important as the profit and loss statement. It tells you your financial situation at a given point in time. Now, let's see where the cash went. The cash flow statement actually explains where all the cash is, because Dr. Patel's balance sheet is only showing $60,000 of cash at the end of the year. So looking at the cash flow statement, you can see that $200,000 went to loan repayments during the year, and $145,000 have been spent on buying new medical equipment, and $100,000 was drawn out by Dr. Patel to support his personal life expenses like private school tuition, family lifestyle, and maybe even a new car. So yes, even though the clinic is making on paper $450,000 of net profit, But by the end of the year, the cash flow is gone to all these different buckets. So therefore, only $60,000 is left in the bank account at the end of the year to allow Dr. Patel's clinic to continue to run. And this is the reality to many small business owners. Ultimately, on paper, it looks like they're doing well and they're doing great. And truthfully, they are. But a lot of the time, the cash is being spent on different things that may not be reflected on the profit and loss statement. Now, let's move on to the second example. We are going to look at Emily's Amazon resale business. Now, let's look at her income statement. Emily sold $800,000 worth of product in 2024. After cost of goods sold and expenses, she was able to clear about $60,000 of profit. She sold $800,000 worth of the product during the year, and after paying for all the expenses, including the cost of purchasing the products, the shipping costs, and the accounting fees, all the business expenses, she's able to clear about $160,000 net profit at the end of the year. It's a healthy margin for an Amazon reseller. Many entrepreneurs would be thrilled to be looking at those numbers. But again, let's look deeper. Let's look at the balance sheet statement. Now, at the end of the year, similar to Dr. Patel's situation, Emily is showing a cash balance of about $25,000. Meanwhile, $200,000 is stuck in inventory, and another $30,000 is still waiting to arrive from the Amazon payout. And on top of that, she owes about $50,000 in loans. This is why I call growing broke. Sales are up, profit is showing, and you have to pay taxes, but ultimately the cash is not there. The cash is going down. Now, it would be helpful to take a look at the cash statement. So we would be able to find out how she spent her money during the year. First of all, she reinvested $100,000 into her inventory, and she repaid about $35,000 of loans. And she also withdrew about $100,000 for herself to spend to support her own lifestyle. After all that, she ended the year with about $25,000 in cash. So once again, profit is in cash. If Emily only looked at the income statement, she would think that she's doing just fine. But in reality, she might be wondering, well, my income statement is doing so well, but my bank account is always living paycheck to paycheck, essentially waiting for the next Amazon payout coming in, and then all the money is reinvested in the business, and she's really living on a tightrope. Now, let's move on and expand our example, because 1 year of profit and loss statement, 1 year of balance sheet, as well as 1 year of the cash flow statement doesn't really show much. It's also important to look beyond just that 1 year. So here's the bigger problem. Most business owners who come to their external accountant would only look at their number once a year. And it's often because they are required to file their tax returns. And if they don't have that requirement, they probably won't even look at how they did the previous year. So they would scramble to put everything together for their accountant. And by the time the financials are done, it would be months after the year end. By then, it would be too late to do anything to change the financial result. 1 year of financial statements tell you history. 2 years of financial statement tells you trends, but monthly financials, that's where the real power is. If Dr. Patel looked monthly, he would see receivables piling up. And if Emily looked at monthly, she would notice that the inventory ballooning before it drained all her cash. And this is why your financial statements should always be acting as a management tool, and it is something that you need to track on a regular basis and review on a regular basis, not just at the tax filing time. And let's not forget, cash flow and taxes are connected. So now let's move on to look at the 2-year comparatives, because as an external accountant, we often present the financial statements with 2 years of comparatives, assuming that you have more than 2 years in the business. Now, if we look at Dr. Patel's income statements with a year-over-year comparison, you can see that the revenue and profit are trending up. So growth is looking promising and positive. Cash dropped by more than a third, unfortunately, and despite the growth, receivable also climbs by about 25%. That means that the collection is getting slower. Well, sometimes the government is not acting as fast, and profitability isn't really translating to liquidity, unfortunately. And without the comparison, Dr. Patel wouldn't be able to notice any of these dangerous trends. Now, let's get back to Emily's situation. Now, Emily's Amazon business, if you look at 2 years of financial statements, look at 2 years of income statement, you can see that the revenue grew and the net profit actually slipped by 3%. And cash plummeted by more than half despite the steady sales, unfortunately. And it turns out that the inventory also ballooned by 33%, tying up all the liquidity, tying up all the cash into inventory. So she's essentially spending a lot of money on buying the inventory, and the inventory is not turning over. Emily is literally growing broke. Sales are up, but cash is down. Without year-over-year comparison, she would think that she was really doing just fine. Now, for smart business owners out there, we don't just look at the financial statements year over year. Yes, it's a good recap of the year, but the reality is that it would be too late before I get the financial statements. It would be too late for us to change the course of action. It would be too late before we adjust our business decisions to fit the trends that we see at the year-end financials. So what we do typically is to look at, as a minimum, a monthly financial statement. So we look at our financials on a monthly basis, and in front of you is Dr. Patel's monthly financial statements. Now, looking at his monthly financial statements, you can see that Dr. Patel's revenue are steady, averaging around $100,000 per month, which is awesome. And February and August are slightly weaker months because patients are away on vacations, on holidays. And December is the strongest month, with revenue peaking at about $120,000. Expenses are relatively stable, but creep higher in busier month. Extra staff and overtime was incurred. Net profit is consistent, but without cash tracking, he may not notice any of his cash flow squeeze. Now, let's get back to look at the balance sheet on a consistent basis, on a monthly basis. If you look at the balance sheet, the cash is declining across the year, even though the profit is steady. Where did the money go? The receivables keep growing. He's working, but he's not collecting. Do we have a receivable problem? Is the government not granting the application? Are there any paperwork problem? Is reviewing some questions that we need to look at. How can we turn that receivable faster? How do we collect faster from the government? So those are the prompting questions that Dr. Patel would need to look into with his team to be able to understand. Now, the third thing that we notice is that equipment value rise gradually. So new purchases, ongoing depreciation, and equipment value at the end of the year keeps going up. That also means that Dr. Patel is investing his equipment consistently. Does he need to do the equipment, invest in the equipment consistently? Is it because it's breaking down, or does he have the obsession with the new equipment all the time? What is he doing with the old equipment? So those are the questions that we need to ask. Loan balance stays high. It remains at about $250,000 at year end. What is he using for the loan? Is it tied to the equipment purchase, or is he tied to just not having enough cash flow coming in? So those are the questions that we need to ask further to understand the business, and then change the course of action accordingly. Equity, the retained earnings, is growing up slightly every year over year. It's a good sign, but unfortunately, if you don't look at all these other factors, you may think that the business is just doing fine. Now, remember, we always need to go back to the third statement, the cash flow statements, to have a complete picture of what's going on. If you look at Dr. Patel's cash flow statements on a quarterly basis, you really should look at it on a monthly basis. Anyway, I prepared it for the quarterly basis. It's better than not looking at it at all. So let's use our example. Each quarter produces a healthy profit, but large outflows eat it all away. And the loan repayments of about $50,000 every quarter, predictable but heavy. Big equipment purchase in Q1 and Q4 create sharp drops in cash. And owner withdrawals are significant. He's taking a chunk of money for his personal expenses, especially Q3. So ending cash never climbs. Dr. Patel is stuck in this perpetual cycle of good profit and low liquidity. So one thing that I would suggest Dr. Patel to do is to make sure that he looks at his spending habit as well. So there may be reasons why he's taking so much money out, and coupling with the fact that he invested so much in his equipment and he has such a line of credit balance, he has such a high loan amount outstanding at the end of the year that we really need an intervention in terms of how he would be able to turn the business around and turn it into a comfortable situation. Now, you may wonder why monthly financial statement matters. For Dr. Patel, he would see collection lagging month by month, and instead of discovering that $200,000 receivable at year end, he could have acted earlier, work with the government officials on collection. He could also plan his loan repayments around months with higher profit. He could also renegotiate with the bank in terms of the monthly amount that he would need to repay. Instead of having a large chunk, he may also be able to extend the term of the loan. He would also be able to spot the cash dip in Q1 and Q4 due to the equipment and debt repayment and prepare accordingly or save up accordingly or have that conversation with the bank accordingly. So now let's switch gear back to Emily's Amazon monthly financial statement. If you look at Emily's Amazon monthly financial statement, you can see that in January to March, the financials steady but not spectacular. And during the summertime, July to September, it's a slowdown. Profit barely breaks $10,000 a month. Now, during the holiday season, from November to December, the profit doubled. Seasonality matters. And it looks like ad costs squeeze mid-year margins. And without monthly reporting, Emily wouldn't know when she's weakest or strongest altogether. Now, in front of you is also the financial statements that are not broken down into further detail. And typically when, as small business owners myself, I would look at the number line by line, including advertising costs, including rental expenses, shipping costs, all these other expenses that would give you more granular detail in terms of interpreting the financial statements to help you make adjustments accordingly from month to month to month. Now let's move over to the balance sheet statement on a quarterly basis for Emily. Now, if you look at her balance sheet on a quarterly basis, you could see that inventory keeps climbing up, which we knew from the 2-year comparison, but this quarterly financial statements is showing even stronger proof that the inventory keeps climbing up, locking up the cash. And cash dropped quarter after quarter because it's being used to purchase the inventory and the inventory is not selling. And receivables also creep up because Amazon pays out are slower, more quality decline, and there's more refund. We don't know. Those are the questions that Emily would need to be able to come up the answer with. Debt rises slightly, financing growth. Equity grows on paper. Again, she's making more money, but cash flow consistently shrinks. So for Emily, she would see the summer slump and holiday boost in real time. She would also know that her cash crunch is tied to her inventory built up before year end. So she could match owner withdrawals to actual cash, not just paper profit. So the ultimate takeaway, the income statement says, you made money. The balance sheet shows whether the money is accessible, and the cash flow statements explains where the money really went. And 1-year results tells you what happened. 2 years shows a little bit of a trend. It's whether it's getting worse or getting better, but monthly really let you adjust before it's too late. Financial statements are not just a box check for CRA, tax filing agency. They are the roadmap for building a stronger, more profitable business. In our next post, we are going to show you some key performance indicator that Dr. Patel and Emily would be able to use to look at their financials and their business all together. And that would help them predict the future and make better decisions as well. Now, if you like our video, make sure that you hit the thumbs up and hit the subscribe button below. Until next time, see you.